Good morning, everybody. I am Murtaza Shaikhally, representing Cedar Management Consulting, and I would like to thank the organizers to provide me an opportunity, who's provided me an opportunity on this fantastic platform, the Africa BankTech Summit. And it's an interesting session talking about banking post the COVID-19 pandemic and during and post the COVID-19 pandemic. So I'll dive into the presentation. Basically, just three broad sections. I'll give you a background and overview of in terms of what we've been facing, more at a generic level, and then also in terms of the banking level. And then we'll look at the trends and the road ahead for banking, especially in Africa. So let me just start by an overall impact COVID has had across the world, specific to Africa, if we focus on. One is obviously, like most regional developing countries and developing regions, the overall growth rate is now expected to turn negative. The good work that was seen post 2019 is now actually the overall growth rate of Africa as a region is expected to turn negative to the tune of about 2%. There is expected fall in the real per capita income, which affects the individuals to the tune of almost 4 to 5%. What is also undoing the good work is actually the increase in the poverty of the regional population, where almost 2% of the population is expected to fall below the poverty line in addition to what is already existing. And most of these are expected to be focused around Congo, Ethiopia, Kenya, Nigeria, and South Africa. And lastly, but not leastly, in terms of an overall impact, the low-income households and the low-income or the small micro SMEs are likely to face the brunt of the impact, reducing their ability to maintain livelihood. So just going by the banking impact of the post-COVID-19 scenario, basically what we are seeing already is there has been a hesitance on the banking and financial sector to step up the credit growth, basically leading to some sort of a credit crunch, whereby this might likely see recessionary tendencies as banks are hesitant to increase their credit spends and credit lending. And also, obviously, to the banks, it has come at a steep cost, and we'll talk about it more as we move along. There has been a huge impact on the small businesses, the micro businesses, which are key customers, especially in Africa. All across the world, in Africa not excluded, is we've seen increase in cyber attacks and frauds as the world is moving to a more digital platform, especially in the COVID scenario. There have been more attacks on corporates, on banks, and there has been a huge focus on looking at cybersecurity moving forward. There is tighter regulation and compliance coming into play, whether it is Basel III, whether it is regulations for ensuring the strength and the stability of the financial services sector. The regulators have been putting in place regulations to ensure continuity, to ensure there is no breakdown in the financial services mechanism and the structure. We also see an increase in credit risk defaults. As we said, incomes from SMEs, micro businesses, individuals have all fallen due to the impact of COVID, especially across multiple business sectors. And that has basically led to an increase in credit defaults, inability for individuals to repay back their loans, whether those could be mortgage finance, that could be personal loans, their credit card outstandings, inability for small businesses to pay back their what they owe the banks in terms of their minor overdrafts or facilities they would be having due to the fall in income. Another big thing that the COVID has led to is basically a drastic or a sharp reduction in footfall in the branches and the ATMs. A lot of work or a lot of transactions have actually moved digital, have moved online because of the inability of people to access branches. A lot of them have had to close down due to the impact of COVID. So there has been a sharp increase in digital transactions, sharp increase in number of in the usage of electronic channels across all channels. And the overall banking model has got practically impacted a lot, and we will see that in the next page. Banking as we knew it has changed a lot in the last 2 years. And basically banks are now looking to save costs by adopting modern technology, by moving on to digital, by reducing their cost of serving the customers, whether it is through brick and mortar and branches, whether it is through channels which are more expensive. They are trying to save costs through moving on to digital channels, whereby it's led by the customer rather than served by actually people in branches. Going ahead and looking at basically the government action post the COVID-19 scenario, there have been relief measures that have been announced for SMEs, and this was highly required, especially in Africa, where there is support for microfinancing, for SME financing, structurally either directly for the sector or indirectly through the financial institutions. Regulatory and compliance area has seen a huge focus. There has been strengthening of the capital base, lowering of base rates. Regulation in the region was anyway on the way up and improving over the past 10 years, and this has seen further focus. We have seen a lot of, as I mentioned in the previous slide, a lot of focus on electronic banking and digital channels. And banks have gone ahead and encouraged the use through waiving of charges, making it easier for their customer base to use the channels, the ATMs, the digital network, the mobile networks, so on and so forth. There have been worker support measures that have been put in place, easier access to ensure social welfare, health benefits, minimum wage programs to ensure the low-income community can sustain themselves through this difficult period. There has been huge focus on cost management as the incomes of organizations and banks and financial institutions have gone down. The focus has shifted to ensuring a reciprocal or a focus on reducing the cost to ensure you maintain your profitability, you maintain your revenue stream, and your ability to sustain yourself. And cost is being looked at not just in terms of cost of resources or people that are managing cost of people in the organization, but also looking at cost of technology, improving the efficiency and cost of technology, improving the efficiency and cost of the processes that are currently there, whether the processes need to be automated, to be put onto the digital network. And also the cost of finally the real estate that the bank and the financial institutions are incurring, whether do we need the number of branches that are currently there, can we rationalize the amount of channels that we have, the branches that we have, the real estate, the corporate offices, and so on and so forth. Work from home is now a reality that we are all facing. As people and staff and employees get used to and be as productive from home as they were from office, this is something being looked at quite carefully by all organizations and financial institutions. Reducing down payments. So basically the financial authorities have encouraged banks and have given SOPs to financial institutions to ensure the payments and the installment payments, the repayments for individuals, microfinance companies, SMEs have some relief in terms of either being reduced, getting a holiday period, getting some waivers so that they can see through this difficult period till regular income flows in. Managing risk and compliance in this scenario has been very difficult because people have been used to the processes whereby files, papers were flowing through. Now, credit has been, or credit approvals, risk process is all online, digital. People need to look at data. People need to look electronically, look at artificial intelligence for scoring, and that has been a key focus area we'll talk on as we move along. And obviously, the reduced interest rates scenario has also impacted the financial institutions. There is reduction in new borrowing and the new rates being made available to customers, whether for refinancing or for new facilities, will obviously lead to reduced margins for financial institutions. So, to look at what all of this is having an impact on the banking model or model for banks is basically the risk-weighted assets have been impacted by higher charges because of the volatility, because of the counterparty risk, because the risk of organizations and their facilities and their lending has been redone based on whether it is IFRS, whether these are various compliance requirements. They are facing a higher charge. Banks' loss allowances have been negatively impacted because now they've had to allow for or provide for a larger share from their revenues. Their non-performing assets have gone up. They were already at high levels in 2019. Africa was seeing at about 11%. And now that's expected to actually move up above the 15% mark. So there's a drastic increase in the NPA levels. And also, as I mentioned before, there is reduced willingness because of the increase in risk, especially in the SME and the microfinance and low-income sector. There is reduced willingness to lend and provide fresh facilities. And they would rather sit on cash and liquidity and capital rather than lend to risks which are more questionable, which is basically leading to crash crunch, leading to recessionary tendencies in many of these economies and regions. Then, as I mentioned, the margins have come under particular pressure for all banks. The interest rates have gone down. The ability to repay has gone down. They've had to discount in many cases, provide customers restructuring for their finances, for their loans and facilities. This has led to a decline in yield on the asset due to competition, whether it is mortgage, whether it is putting the assets into investable grade assets. The net interest margin of the banks and profitability has come under severe duress. As we mentioned, there has been increasing stress on the quality and profitability of the assets. The daily wage earners have been hit the hardest. The sectors that have got impacted has been the services sector, the farming, the tourism, the trading sector, where majority of the population in Africa and developing regions like Asia are basically employed. And the small and the businesses that have never been most efficient are affected here, where their inability to pay has caused a spike in the non-performing asset ratio. The overall cost-to-income ratio of banks, which was already in the higher bracket, has actually increased further. And that has basically led the banks to look at all sorts of cost reduction, whether you're looking at real estate, you're looking at systems technology, you're looking at headcount and personnel reduction, which is further causing pressure on individuals to basically maintain their income. To look at general trends, and I don't want to go into each and every one in deep order, but just as the real GDP growth was actually moving for the better till we hit to 2019, and now that is expected, as I mentioned, to see a negative growth. Most African countries have large number of banks and FIs. However, if we dig deeper, it's basically the top 10 or 15% of FIs primarily control 85 to 90% of the market. And then you have a plethora of smaller financial institutions serving specific needs or serving the needs of the SMEs and microfinancing. The inflation rate is expected to go up further. The public debt is expected to go up further from the levels that we have already seen before. So there's going to be an excess strain on the financial system. One place we have seen a trend in most parts of the world, and Africa not staying behind, is basically the consolidation of financial institutions. So we have seen a few mergers in across 2019, 2020 in Africa too, where we have seen Kenya's central bank approving the merger of the Commercial Bank of Africa and NIC Group. We have seen Bank ABC and KCB in Tanzania merge. We've seen Standard Bank acquire 35% in TradeSafe. We've seen KCB and BPR, Access and Transnational Bank. Goldman Sachs acquiring stake in Capital Bank. So this is a trend which is likely to continue and probably see a lot of activity in based on the reports coming in, not only in Africa, but we've seen this trend across Middle East. We've seen this trend across Asia and the developing economies, which will probably lead to larger, more stronger financial institutions, might lead to obviously reduction in number of financial institutions, but will be more stronger financially stable organizations. Now to look at in terms of where the banks have been moving in terms of fintech technology and their investments over the past few years, and this I'm comparing Africa to the global markets. So universal banking solutions, we've seen across the last 2 or 3 years, large number of banks undergoing either upgrades or changes in their core banking solutions. We've seen Standard Bank, we've seen National Bank of Egypt, Bank of Africa. Some of the key suppliers to the African region has been Temenos, has been Oracle, has been Part Solutions, has been ICS, Sopra, and Neptune. So these have been primarily the solutions of choice or universal banking solutions of choice across the last 2 years for banks in Africa. As you see, I mean, in most of these solutions, you will see a downward trend in 2020 for obvious reasons, but it's expected once you move into a post-COVID environment, it will pick up the trend that we saw from 2015 onwards, which was banks looking to replace old technology and old systems with newer versions and newer generation technology, especially core banking, which is basically the backbone of most organizations, financial organizations. Looking at wholesale banking, we've seen some change in African countries, lesser transactions, probably 10% of global transactions, but we've seen banks change. We've seen Edgeware, which is an Infosys company, Profile Software, Finastra, Oracle, Calypso, being very active in this space over the last 2 years. These are large international companies, and the good news is that large international companies now see Africa as a key potential area. They see an opportunity to provide most financial organizations with the latest in terms of technology, in terms of digital enablement and systems whereby they can be on a similar pedestal as most banks across other developing regions in Middle East and Asia. Private banking obviously is seeing a little bit of action over the last 2 or 3 years. Systems here in Africa, obviously most of what happens in private banks is typically your universal banking systems get used for private banking too, but there are certain specialist providers like ERI Bank Air, EBIX, Finastra, providing solutions over the last 3 years to some of the key banks here. Bank One changed, FNB changed, NetBank in South Africa. prime bank. So you've seen some movement in private banking too. I expect this to grow over the next few years once COVID stabilizes and as wealth management becomes more and more critical. This is the area where everyone has seen very, very rapid growth up to 2019, obviously a downturn in 2020, but this is where there is most action across most developing regions. We've seen the global providers, whether it's Backbase, Oracle, Infosys with Edgeworth, Temenos present in Africa and working with banks in Africa. There has been large amount of change that has already taken place, and that digital change is now continuing. The good news is that while we first looked only at enablement of digital processes for the customers at the front end, more and more back-end processes are now being also put through the digital platform and digital enablement, whereby you're seeing STP or straight-through processing right from customer initiation right up to their service delivery in the back end. And that's basically what is also required as we move on. We'll see in COVID period and post-COVID period to improve efficiency, improve revenues, and reach a larger population base. Digital and mobile enablement will help. Similarly, these are the lending systems. And we've seen, again, in this area, Oracle, Nucleus software, FICO, in IDA, which is Intellect Design Arena, X Finance, put in there and sell solutions to large financial institutions here, whether it's in North Africa or South Africa, you're looking at East Africa. People looking to ensure that the lending process, enablement and digitalization, right from customer initiation to their credit scoring, to their credit assessment, and eventually their processing is all on the system and automated along with relevant document management system integration. This is an area which will see more and more focus, which was seeing a huge amount of focus in 2018, 2019, and will continue to see, which is risk and compliance. As bank, as I had earlier mentioned, there is an increase in areas of fraud, in areas of digi attacks that have happened. This area is looking more and more at AML, at fraud, at risk, and investing into solutions towards this end. And payment solutions, which are led by, again, IDA, Oracle, Temenos, across banks in Africa, enabling digital remittances, payments for the larger community, and through tie-ups with mobile banking. So in terms of key takeaways that we have noticed, we obviously know SMEs constitute a large portion of customers, of non-individual customers in Africa, and leveraging new technologies and digital and mobile is the way to reach, especially in a post-COVID environment. We did see top few banks constitute a large part of the market, and microfinance and SME institutions playing a significant role outside of that to improve the reach to population, especially in rural areas. We've seen a lot of domestic mergers across that's actually supposed to continue across Africa, Middle East, and Asia. And economic landscape and government support, we've seen direct and indirect support to SMEs and microfinance institutions. Social programs, which primarily look at health, food, and welfare to ensure the low-income population are taken care of during this hard time, and focus on digital and mobile to improve the reach, reduce cost, and improve efficiency moving forward. So basically, this is just the last few closing slides in terms of outlook post the COVID era. In terms of what we have seen, we'll see consolidation across borders within the country. Certain larger financial institutions looking to specialized institutions to improve their offering, to improve their reach, We will continue to see regulatory regimes looking to AML, to compliance, to ensuring reduction in risk and fraud, and improving overall corporate governance of each financial institution. The good part is there is increased customer focus through innovation, through use of AI, through use of machine learning, which will improve the use of alternate channels and reduce the load on branches. Over the next couple of years, while we might see challenging credit growth, the statutory authorities and bodies are still putting in play policies to improve that. Most financial institutions are heavily looking into cost efficiency and operational efficiency to reduce costs and meet or ensure they survive in an environment where revenues are under pressure. And they are rethinking of business models and ways to do that. Digital is one of them. And obviously capital and fundraising activity is being assisted by regulators to ensure that there are capital reserve requirements are being looked at, funding and bonds are being looked at to ensure that there is ease of capital availability, there is fundraising possibility for financial institutions, especially for improving credit growth. We've seen digital banks across Africa come up, and this is one area where we'll continue to see growth, whether it is in South Africa, whether it is in Uganda, Nigeria. We've seen a lot of growth in digital-only banks, whether part of large organizations or standalone digital organizations. We've seen in developing regions, especially in Middle East and Asia, now even Africa has seen that growth and will continue to see that. And last but not the least, in terms of fintech activity, this fintech activity, there are more and more fintech players now partnering with financial institutions across Nigeria. We're granting more licenses to payment services banks. In South Africa, where now mobile point of sale MPOS players like Yoko and iKoko are making inroads into the SME market. In Ethiopia, where a national digital transformation plan is being put to place to be in place by 2025. In Egypt, in Kenya, and all major financial centers, fintechs are now playing a larger role, partnering with financial institutions and bringing efficiency, bringing new products and services to a larger population base. So that was it. I thank you very much. I hope I could shed some light in terms of where banking is headed to in the post-COVID era in Africa.